Dear students, welcome you all for the session. I am Dr. Dinesh, Assistant Professor, School of Management, Shastra Deemed University, Tanjavur. In this session, I am going to explain about equity and debt funds. Before going to this particular topic, I need to revise the concept of mutual fund. Mutual fund is a vehicle for collecting investment from the investor, and that investment is going to invest across the different investment avenues. So the mutual fund is called it as collective investment vehicle. It collects the investment across the different investors based on their risk profile, what they want to invest. They collect the investment from them, and according to the investment objective, those investments are invested into the market. Related with the different securities, it is being invested in shares, invested in debentures, invested in bonds, and other marketable instruments in which the mutual fund is investing. So it is going to be the diversification of risk. Why mutual fund is called it as diversification of risk? Because if you as an investor directly you wants to make investment into the market, you directly can able to buy a quantum of shares. At least the portion of securities what you have been invested, fully you can be able to subscribe, able to buy the securities from the market. But through the mutual fund, you need not to buy the entire securities. A portion of security can be subscribed under the option of mutual fund. That is what, for example, if you are going to invest in NFO for a new fund offer, say for example, the new fund offer has given you the unit price of 10 rupees. Unit price of 10 rupees. Across different companies, the fund is going to be invested. The 10 rupee, for example, if they are going to invest across 30 different stocks, it means that every 33 paise is going to be invested. 33 paise is going to be invested across the different stocks. But in reality, it is not at all possible that you are going to make investment. The partial investment into the market is not at all possible. Or partial subscription of securities is not at all possible in the market. It can be possible through the mutual funds. So that is what the mutual fund is, a vehicle for investment, and those investment invested into across the different assets. We call it as the mutual fund is a collective investment vehicle. The mutual fund is a diversification of risk. This category, the diversification of risk, even you can buy the securities, the whole security can be purchased, but the risk and return is associated with the stock what you have invested. But in this mutual fund, invested in different sectors, sectoral fund, different capitalized funds, in different market segment it is going to be invested. Across it is going to invest in equity market, or going to invest in debt market, or combination of equity and debt market it is going to invest. Even it is investing in derivatives market, commodities market. The different investment is proposed by the mutual fund. So that is what the reason the kind of interest among the investor is increasing over the period of time for making investment into mutual funds. Drastically it is increasing year on year. The people are interested to invest in mutual funds. Especially there are different types of schemes, different types of options are provided by the mutual fund. We can have like systematic investment plan, systematic withdrawal plan, systematic transfer plan. There are a number of such options which encourage the investor to invest into the market. According to their requirement, they can able to invest in the market. For purchasing of securities is not going to fulfill your requirements, but the mutual fund is going to fulfill your requirement. What purpose you are going to invest? What is your investment objective? What type of investor you are? If you are interested to take more risk, there are a set of schemes, a set of fund options are available for you. if you are a moderate risk taker, or you don't want to take any risk in the market. Accordingly, the satisfying different types of investor, different plans are proposed by an asset management company in the market. One of such major thing in which the people are interested, showing interest to invest across equity funds and debt funds. Especially in equity fund is a general terminology. Different asset management companies are having a different types of funds under the category of equity fund. Similarly, the people who wants to make invest into the debt fund or liquid fund, there are a different option, different investment proportions are available for making investment in debt and debt related investments. So this is about overview of this particular topic. Next one, equity fund. What exactly the concept of equity fund? Equity fund or the mutual fund scheme which invest their assets in stocks of different companies. It is going to invest and based on the investment objectives of underlying schemes. What scheme you are going to invest? There are different schemes are available under the category of equity fund. So equity fund is primarily going to invest into equity shares of the different companies. Almost they are going to make investment, more than 80% of investment is invested into equity and equity related investments, or those instruments the funds are invested. There are special classifications of equity funds. We have equity linked savings scheme, at least for 90% of the investment into equity is eligible for getting tax exemption. Tax saving schemes are also available, while whatever the investment that you are investing into the equities or investing into the kind of schemes which are having a exemption to make the payment of tax. So this equity fund basically investment into the companies, investment into the company stocks, it is going to be invested. Purely the equity fund investments or across all the different funds, the investment is purely based on the objectives of a particular scheme or underlying scheme or a current scheme, whatever the fund they wants to invest in the market. That is what type of investor you are, what type of need you have joined with this particular scheme is going to be fulfilled. It is you are expecting some income out of the scheme, or you are expecting some capital appreciation out of the scheme. Whatever the purpose that you have joined with this particular scheme is going to fulfill the requirement of such a scheme. And these funds great investment option for the capital appreciation. Primarily it gives the importance for the capital appreciation. Since you know the rate of return given by the instrument, accordingly the investor is going to invest in the market. So in that, the first thing that I have explained about the mutual fund is investing across different investment avenue. You know that the various investment avenue we can classify into marketable securities or non-marketable securities. We are evaluating such securities in terms of their characteristics. Primarily we are evaluating the security in terms of returns given by the security. So the returns can be classified into current return and capital appreciation. The current return which is given based on the scheme, based on the investment done by the asset management company across the different stocks. Whatever the current return is given in terms of dividend, in terms of interest is given. So this is one particular objective of investing into equity fund based on the current return. Based on the capital appreciation, what the stocks you are investing, what about the changes in price over the period of time, whatever the stock you have invested. Across the different stock you have invested, the price is going, it goes up, your NAV is also goes up. NAV is a net asset value, it indicates the price, indicates the movement of price in the market. Since you have invested 10 rupee, currently in the market the NAV of 17 rupee, it gives a growth of 70% during the period of time. So it is a kind of an indication where we can able to know that the amount of appreciation, the capital appreciation happens in the market, the amount of payout happens in the market, the amount of income generated by a scheme in the market have been analyzed, the potential of the particular scheme have been analyzed. It is for a long-term wealth creation is a major objective of equity fund. So there are certain conditions which are prescribed in Securities Exchange Board of India Mutual Fund Regulation Act 1996. So few regulations that are related to the equity funds, which is given in Securities Exchange Board of India Mutual Fund Regulations Act 1996. According to this, the regulation related to the equity fund investment. So the first one, a scheme cannot invest more than 10% of its asset into a single company's shares, cannot be allowed to invest, or the share related instruments, we call it as equity or equity related instruments, it cannot be allowed to invest more than 10% for the single company. However, the kind of a sectoral funds can have a higher investment in a single company. It's like we can classify the equity fund into different categories, like the large cap funds, mid cap funds, small cap funds, sectoral funds, fund of fund scheme. There are different types of schemes which we have classified the equity fund. So apart from the sectoral fund, in remaining funds, the investment into a single company is restricted to 10% except for the sectoral funds. Because the sectoral fund, there are limited stocks being identified, it has been included in the portfolio. Hence, it is permitted to invest even more than 10% of its assets into the single company. But whatever, it should be mentioned in the scheme information document, it is to be mentioned why such kind of investment, it means more than 10% is invested into such a scheme. The reason you just have to mention in the scheme information document. And the mutual fund are meant to invest primarily for the listed securities. Primarily it provides the listed securities, it is allowed to make investment. However, it is also permitting to make investment into unlisted securities also. But primary reason in which they are insisting to make investment into listed securities, because those listed security can be traded easily in the market. Market prices are applicable for those instruments because it is being listed in the market. The stock exchange is a place where you can buy and sell the securities which are already issued in the market. The marketability is applicable for securities. So it is easy, rather you are going for investment into unlisted companies. It is like going to be the real investment. If you would like to buy or would like to sell, you can approach the help of the intermediary for doing this particular process, but it is not required in this case if you are going to make invest into listed securities or the listed companies in the market if you are going to invest. However, the SEBI has permitted to make investment into unlisted companies too. So the norms here for the open-ended scheme and closed-ended scheme. For the open-ended scheme, it is permitted for the maximum of 5% of its investment. It means based on the total net asset, they can invest up to 5% investment into unlisted companies. For the closed-ended schemes, they can invest up to 10% of its total net assets held in the market, or the total value of investments held in the market for the particular scheme. They can able to invest up to 10% of their fund into unlisted securities in the market. So the classification of open-ended and closed-ended scheme you know already. The open-ended scheme in which the investor can join at any time. Investor wants to redeem their units at any point of time. But the closed-ended scheme, you can able to invest in closed-ended scheme for specific period of time. After the specific period of time, if you would like to withdraw, you have to wait till for the end of the term of particular closed-ended scheme. So open-ended scheme has permitted to make investment into unlisted securities up to 5%, and the closed-ended scheme can able to invest up to 10% into unlisted securities based on their value of net asset in the market. And the mutual fund scheme cannot invest more than 25% of their net assets in the listed securities of the group of companies of the sponsor. That is to be the important aspect. It cannot be permitted. There is less than of a 25% can be permitted to make invest into the group of companies which are maintained or managed by the sponsor, because you know the sponsor who has contributed a capital for the asset management company. For those company, you are not allowed to make investment more than 25% of your fund, or more than 25% of a scheme's net asset is not permitted to invest. And all the schemes of mutual funds are put together cannot control more than 10% of the voting rights of any company. You know, an asset management company is managing the funds of investors. They are making investment across the different securities. But it should not be whatever the schemes that particular asset management company may have. Even asset management company may have hundreds of schemes. If you are taking the total investment into a single company, it should not be more than 10%. Even you can take a company have a total paid up capital of a company is 100 crores. A mutual fund company or asset management company in a particular scheme, they have invested 2 crores into that particular company who have 100 crores of paid up capital. So in a particular scheme, already 2% is invested. They have started another scheme. In that particular scheme, in that particular company, they have invested 7 crores. It means 7% of the fund is invested with respect to the previous one, 9%. In another scheme, if I am going to invest on the company, you can take the company as A. In the A company, I cannot be able to invest more than 1%. It cannot be permitted. So this is what the regulation is being imposed by Securities Exchange Board of India against the asset management company. So it cannot be invest more than 10% across the different schemes. Cannot invest more than 10% to a single company. And the mutual fund schemes cannot charge management fees on their investment in other mutual fund schemes of the same asset is managed by the company or the asset management companies, we can say. Such investment is also subject to the cap of 5% of net assets of their funds. This is not applicable for the fund of fund scheme. For rest of the schemes, this management mutual fund schemes, there is a management fee is applicable. So this is about they cannot charge the management fee on the investment in other mutual fund schemes. They can able to charge that only for the specific scheme. They can able to charge the management fees. And fund of fund scheme, the management charges or the management fee cannot be charged, because the fund of fund scheme already is a fund where I am going to invest. So already there is a fund called diversified equity. There is a fund called sectoral equity. There is a fund called multi-cap fund. These schemes where I am going to invest, a new scheme, that we call it as fund of fund scheme, cannot charge the management fee on this particular aspect. Charges is not being levied because already it is levied for the individual schemes. inter-scheme transfer of investment is also done. But even if you transfer the asset from one scheme to another scheme, you can able to transfer only on the market prices. It is considered that one scheme is going to buy the asset from another scheme. So it is not simply you are going to transfer on the purchase value. It is going to be transferred only on the sales value or only on the current market price in which the securities are traded in the market. The fund of fund scheme cannot invest. So what is fund of fund scheme? You can take an example that the equity fund have a different types of schemes in the market, like diversified equity scheme, small cap scheme, mid cap scheme, large cap scheme, multi cap scheme, sectoral schemes. Like the different schemes are owned by a equity fund. So what the asset management company, whenever they are going to start the kind of a scheme, they are going to float the way in which they are going to make investment. Here what they are investing across the different funds instead of investing into the securities, because indirectly it is investing into the securities, directly it is investing on the funds. As like as how the investor is going to invest, similar way the asset management company is going to invest into the different funds. That scheme we call it as fund of fund scheme. That scheme is called it as a fund of fund scheme. And any other fund of fund scheme or other than the asset management schemes of mutual fund, except meeting the liquidity requirement, which must be disclosed in the offer document. What scheme it is going to be invest, how much the proportion of investment into such schemes. There are the factors which highly influencing for making investment into equity funds. Specifically, the first one is economic cycle. What is the kind of a trend is going on in an economy? How it is going to boosting the growth of economy. Based on that, the economic factor, the growth rate of a country. It is like the prevailing inflation, prevailing conditions, the availability of resources, regulatory requirements, or those factors are influencing highly about the performance of equity schemes in the market. So these are the factors which influence to make invest into equity funds. These are the sectors or these are the variables are being considered for making investment into equity funds. And the equity funds are invested on the basis of economic cycle. It means what type of trend is going on. What about the investment of foreign institutions in Indian market? What about the growth happens over the period of time? That is a factor which influencing the asset management companies to invest into equity funds. Second one is about the valuation of investments. Whatever the companies you are interested to invest or you have invested already, in those investment you are going to measure the price earning levels. Market price and the earnings of the company over the period of time is being compared, is being evaluated to arrive the relative position of the company in the market. So the earning stability is being measured for the specific scheme. That also helpful for the asset management company to make investment into the market. And earning trajectory is also the factor influencing what is the potential of earnings over the period of time for the particular company. It is predicting, it is forecasting over the period of time. What may be the growth rate that happens over the period of time for the particular company for making investment into that company. And the political environment, legal environment, market sentiments are the important factors influencing the asset management company to invest into equity or equity related items. We can classify the equity schemes. The equity schemes are primarily classified into diversified equity scheme, small cap equity scheme, mid cap equity scheme, large cap equity schemes, thematic equity schemes. We can say the thematic equity schemes are like a sectoral equity schemes. index schemes, tax planning schemes. So it's like the first one is going to be the diversified equity scheme. Across the different sectors, the investment is proposed by the asset management company for investment into such a scheme. We call it as diversified equity scheme. For example, is given here HDFC asset management company. They have a scheme called Top 200. So in that top 200 companies, on the basis of market capitalization. So what is market capitalization? The market capitalization of a company is being identified based on the current market price in which the shares are traded in the market multiplied number of outstanding equity shares. You can able to know relatively what position of the company in the market. What is the capitalization? The market capitalization is being identified. On those basis, the top 200 companies, the investment is done by the HDFC. The scheme is called a top 200 schemes. Across the different sectors, like the banking sector, automobile sector, you can take pharma sector, infrastructure sector, like different sectors, the investment is proposed under the scheme. Similar to this, Reliance Vision Fund is going to invest. The Reliance Asset Management Company is investing into the diversified equity scheme. They have invested already in the market. The Reliance small cap, mid cap and large cap equity schemes. Investment under the schemes done by the asset management companies on the basis of market capitalization of a company. So relative market capitalization of the companies, they are going to make invest. Relatively the small companies or small capitalized companies, they are investing. Medium capitalized companies, they are investing, and the large capitalized companies, the investments are done by the asset management company. Because the risk level is differ across the different capitalized companies. The large capitalized companies are like a blue chip shares. They are highly stable companies in the market. There is no much kind of fluctuations happens. There is a steady growth is happen under this kind of a companies. We have large capitalized companies. But the expected rate of return cannot be able to get out of these companies in the market, because the minor changes, minor movement changes is happens in the market, especially for the large capitalized companies. Even the investors who wants to make invest in this large capitalized company can able to participate, can able to get the rate of return. It is compared to other investment avenues, it is better to invest in large cap equity scheme, large market capitalized equity schemes, where the investments are proposed into the top companies. Like for example, they are going to invest in the companies listed in Nifty, the top 50 companies, or CNX 100, the top 100 companies is going to invest across the market. So these are the companies or large cap, it means large capitalized companies in the market. Medium capitalized companies, next to the large capitalized companies, there are companies, financially stable company, can able to provide, can able to meet out the requirement of investors, can able to provide the required rate of return to the investor. It means compensating with the rate of risk associated with the investment in the market. Those stocks, those investment, the asset management is company is investing, can say it is mid cap funds. Small cap funds have high volatile movement in the market. Risk exposure is high for such stocks. The expected level of return is also high for such stocks. So the investor, the aggressive investor who wants to make invest, they might choose the scheme called small cap scheme. They can be able to get abnormal rate of return. Even the kind of losses is also, the heavy losses is also happen by making investment on this kind of investment schemes. For example, ICICI has the ICICI Prudential Multi-Cap Fund. Across the different capitalized fund, the investment is proposed by the asset management company, ICICI Prudential Asset Management Company. thematic schemes, or otherwise call it as a sectoral schemes. So in this sectoral schemes or a thematic schemes, it is going to invest into a particular sector. For example, invest into infrastructure sector or commodities or multinational companies. They are going to investing into services sectors like the banking sector, financial services sector, tourism sector, hospitality sector. They are going to invest. They are investing like the other sectoral funds, like for example of pharma, automobiles. They are investing. Manufacturing sector, they are going to invest. Cement sector. So like there are different sectors in which the company is going to invest. The scheme, what we call it as, is a sectoral scheme, or we call it as a thematic schemes. For example, UTI Betro, the Betro chemical companies, where the investment is proposed by Unit Trust of India. Franklin Templeton, they have Infotech Fund. The Infotech Fund is going to invest in information technology companies, information technology and information technology enabled companies. They are making investment. Reliance Pharma, the pharmaceutical sector, the company is invested by the Reliance Asset Management Company. These are the examples to know about the thematic equity schemes. And the index fund, where the scheme has replicating the weightage given by the index. The same amount of weightage is being taken by the asset management company while they are going to select the securities in the market. For example, Franklin India Index Nifty scheme. So, National Stock Exchange has a benchmark index called S&P CNX Nifty, where the Nifty is going to invest. It means the Nifty has included the top 50 companies based on its market capitalization. In those companies, they are going to invest the asset management company. It is entirely the replication of an index where the investment is proposed. Instead of asset management company is going to construct on their own portfolio, they can accept or they can adopt the existing portfolio constructed by the stock exchanges. We call it as an index fund. So one of such index fund is given here is a Franklin India Index NSE Nifty fund. And another fund is a tax planning schemes, tax saving schemes. For example, Reliance Tax Saver ELSS, equity linked saving schemes. Where in this type of scheme, where the 90%, a minimum of 90% of the funds are invested into equity or equity related instruments. So that is going to be the fund or the scheme has classified into the tax saver plan, or the scheme has classified into equity linked saving scheme. And the Franklin India tax shield scheme, or the example for tax planning funds. The first one, the large cap mutual fund schemes. Elaborately, we will see the important concept of large cap mutual fund schemes. These funds are usually mandated to invest in predominant portion of their assets into multi-capitalized companies, large established companies. It means the large capitalized companies where they are going to invest. The companies which stand at the uppermost in the layer of a market in terms of its market capitalization. But we can say the bottom, it is the top of the pyramid where the companies are classified. Like for example, those companies are included, the top 30 companies are included in Sensex. Similar way, the top 50 companies are included in Nifty. We can say those companies are classified in terms of market capitalization. They are the companies which stand in the first, which stand in the the topmost layer of the pyramid. We can say those funds or those companies as a large capitalized companies. Like for example of ONGC, Infosys, TCS, Bell you can take, ICICI Bank. Like those companies are classified as large capitalized companies. The companies which has established well established businesses and they have a stable revenue. Those companies are also classified as a blue chip companies, financially sound companies in the market. They have high market share in terms. You can say I'll tell you an example to understand what is market share. In case in the market for a particular product is being sold in the market, a company has sold, one particular company has sold around 30 product in the market. We can say that company market share is 30%. Similarly, the market share for those large capitalized companies are relatively high compared to all other companies in the market in the same segment, what they are manufacturing or what they are producing. Like for example of HUL, Hindustan Unilever, Nestle, P&G. You can take it as an example where those companies, the market capitalization is high compared to other companies they are in the market. And they have a high market share usually as they are well researched companies. By the research team, they will give the performance of those companies over the period of time. Their performance is more predictable, is going to be closely we can able to know that what happens in the company, what about the future plan of the company, what they are investing, how they are investing in the market, everything that you know, that their expansion plan or their diversification plan or their future is predictable. They have a ability to weather unfavorable economic conditions, even they are doing well in the market, even though kind of unfavorable economic conditions, they can able to generate the profit. Those companies, we can say the companies are a large capitalized companies. They are the companies determining even for the economic conditions, contributing more to the economic growth. These companies are generally command as a premium over mid and small companies. Compared to that, these companies are the premium companies, we can say large capitalized companies. Second one is mid-capitalized companies or mid-capitalized mutual fund schemes, where this kind of schemes investment is going to be proposed. The mandate that the predominant portion of funds into or the investment into mid-cap companies, medium capitalized companies or medium market capitalized companies, which falls below the large capitalized companies. But above the small capitalized companies, the market capitalization, in terms of market capitalization pyramid. Some traits about the mid capitalized companies are they are well established companies, they have a potential for growth as they are yet in the growth stage in their life cycle. So in that life cycle, the company has started and they are growing in the market. The growth stage is a replication or index of the medium capitalized companies. They are the learner in size, but they have the ability to accelerate their returns on investment over the period of time. The rate of return generated by the company in terms of their investment, in terms of their shareholders fund is high compared to their compared to other companies are there in the market. It means the company has a more potential in future. And they are often less researched. They are not going for much on this particular part. They are more volatile, that they tend to show the fluctuations of profit at the time of their struggle to sustain. When they are get into tough, things are going to happen. Because compared to the large capitalized companies, the small mid capitalized companies are fluctuating returns. But the large capitalized companies are not having fluctuated returns. As the name suggests, the small cap mutual fund schemes, those funds or those companies are relatively low market capitalization compared to the medium capitalized companies and large capitalized companies. Relatively, their earning capacity is also low for those companies. So these funds are known as micro-capitalized funds, are usually mandated to invest a predominant portion of their funds into a small market capitalized companies, which all fall below the medium capitalized companies. So they are at the bottom of the market capitalization pyramid. So the pyramid, you can take the top of the market capitalization pyramid is called large capitalized companies. Medium of the market capitalization pyramid is called mid cap companies, and lower to this, the bottom of the pyramid, bottom of the market capitalization pyramid is called small capitalized companies. What are the basic characteristics of those small capitalized companies? The first one, these companies are often under-owned companies. It is undercapitalized companies. Their relative capital position in the market is low. And the second one, they are learn in size of compared to the medium capitalized companies, small level companies. They have very small level operations. They don't have even the time for doing research or establishing themselves into the market. They can able to only survive in the market. For the survival, they can sell the product in the market. Even they are penetrating in the market. The volume of transactions and the liquidity of small cap company is too low. Liquidity position is low. The cash management position of a company is too low. The profitability of a company is too low. Their reserves and their net worth relatively is low compared to the medium capitalized companies in the market. And thus investing in small cap company which carries a huge amount of risk to the investor who wants to invest in the market. If I am going to invest, because why the investor are giving priority to invest in small capitalized companies? Because those market price are low compared to the medium capitalized companies and large capitalized companies. These micro capitalized companies, the investor wants to invest because they can able to invest in multiple stocks or can buy more number of shares from this company. Relative changes, the small amount of changes even can give the more benefit to the investor where they are going to invest in the large capitalized companies. And they have a potential to generate the supernormal returns. Abnormal rate of return can be generated over the period of time because the companies are highly volatile in the market. The stock prices of those companies are highly volatile in the market. The profitability is somewhat compared to the medium capitalized company is low, but their relative performance is have highest impact in the market prices. And multi-cap fund scheme, these are the funds facilitate to mandate invest across the market capitalization. It means they are also investing the different pyramids of a market capitalization. Investing in large cap funds, investing in mid cap funds, investing in small cap funds or micro cap funds. They are investing across the different capitalized funds. Thus, by doing so, they can spread their risk across the different market or the different market capitalization, and even capture the investment opportunities across all different segments. Moreover, they can not able to confine into one particular style of investing, which allows them to follow a value growth blended style for making invest into the market. The proportion in which they are making investment. For example, the multi-cap fund, like the 100% of the investment collected from the investor, 95% is going to invest into equity. It means across different capitalization the funds are going to invest. For example, 35% is going to invest in large capitalized companies. Hence, 30% is going to invest into small capitalized companies and remaining 30% is going to invest in medium capitalized companies. So like the proportion of investment is going to invest across the different capitalized companies in the market. We call it as multi-capitalized funds. These are the funds, we call it as flexi-capitalized mutual fund schemes. These funds enable to mandate or aim to operate or optimize the exposure to every market capitalization or the segment depends on its attractiveness. Or other words, the flexi capitalized funds It can work a large capitalist fund if the fund manager expected a better performance in the large cap, and if may serve as a mid cap and small cap funds if the fund manager turns into bullish in the mid-sized companies. So basically what is bullish and bearish. It is expected market trend. It is depends on the market condition. We can say the type of pattern what it is prevailing in the market. If those stock prices are increasing over the period of time, are increasing, day trading are increasing, or market price movements are increasing on every day, we can say the particular movement as bullish trend. If those price movement of the stocks are relatively low or negatively traded, it means low price it is traded in the market, we can say the bearish trend. So based on the trend the investment is done. So basically this previous one is focusing multi-cap fund is going to invest across the different capitalized companies. The investments are proposed as I gave you the example, like 95% in a scheme, 95% of the fund is invested into multi-cap fund. It means 95% invest into equities, 5% invest into cash or money market segment. Out of 95%, 35% is invested into large capitalized companies, and remaining 30% each investing in mid cap and small cap companies. So it means a proportion of fund is invested across the different capitalized companies. The pure diversification is going to happen across the different sectors in that multi-cap fund. Whereas the flexi cap fund is going to invest, it is going to invest in large capitalized fund if they feel that the large capitalized funds are doing well in the market, and they divert the funds to mid cap or the large or the small cap. Depends on the market, depends on the market performance, depends on the companies with the small scale companies or medium scale companies or large scale enterprises. Based on their performance they are going to invest. We call it as flexi cap funds. Moreover, the kind of a fund is one step ahead, switching between the asset classes. It means debt and equity, which flexibility go to the 100% in each of the site. 100% of the fund is invested into large cap. If the large cap is not performing and we confined ourselves to the small cap companies are performing well, those funds are to be withdrawn in the market and it is invested into small capitalized companies. The next one is sectoral or thematic schemes or sectoral or thematic funds, where they are investing. The focus is to invest on the particular sector. For example, banking sector, automobile sector, financial services sector, infrastructure sector, pharmaceutical sectors, like the consumable product manufacturing, like those sectors what they are going to invest. The sectoral invest which can facilitate the investor to choose their own sector for making investment. During the pandemic, what we feel, which type of sector is doing well in the market, it is like a pharmaceutical sector or healthcare industry. So like based on the trend what it is prevailing in the market, across the fund is going to be invested in the market. We can say the scheme as sectoral scheme or thematic schemes. The focus to invest into the particular sector is given. Second important thing, the dominant portion of the fund of asset is invested into the respective sectors. For example, the ICICI Prudential has BFSI scheme, banking, financial services and insurance scheme. It means the funds are invested across the banking, financial services companies and insurance companies. The investments are proposed. So those companies only they are going to make investment across the fund collected from the investors. Thematic funds are a variation to sectoral funds and have slightly broader mandate to invest in the following themes. Like thematic funds could invest in the themes like infrastructure, consumption companies, like different the kind of themes also they are investing. Trends also they are investing. Lifestyle companies they are investing. It is not specific to the sector. Thematic including of sector, including of certain qualitative factors are also considered while making investment into the market. The next one is index funds. These are the funds which are aligned with the respective benchmark indexes. So that is what in the previous example I have quoted, like Reliance Nifty fund, where it is a replicative index is S&P CNX Nifty. So those 50 companies, what proportion it was included as an index in Nifty, the same proportion is being followed by the asset management companies for making investment on those companies. So that the fund we call it as index fund. So the portfolio of such funds are replicating the composition of the terms allocated, or we can say the weightage assigned to chosen the index. Let's say for example an index has been constructed. So this index funds replicating the weightage given by the index. For example, you assume that an index consists of 10 stocks. The overall capitalization of an index is contributed by stock A is 18%, B is 22%, and C is 5%, D is 2%, like that. So the same amount of weightage in which the investment is done by the asset management companies in terms of the funds received from the investor. For example, in the company A, they are going to invest 18% of their funds. So similarly, what the proportion in which the index are constructed based on the market capitalization of the company, relative weightage is being given to invest into such stocks which are included in the index. So that we call it as index funds. That is what it is given here. The portfolio of such funds replicates the composition in terms of allocation or the weightage of chosen index. And these funds are nearly is going to be the mirror of performance on the designed, or we can say it is going to be the designated benchmark index. Whatever the performance of a benchmark index is being replicated into the index funds. Because the index funds, the investments are proposed by the asset management company, whereas the index is constructed based on the market capitalization of the company. So based on the market capitalization of each company with respect to the total market capitalization of an index, the weightage is assigned in the particular index. Those weightage is followed by the index fund while they are going to make investment into the market. And in the index fund is a passively managed. It means, there are two ways in which the mutual funds are being classified into active investment and passive investment. In the active investment, the asset management companies are participating. They are regularly watching. They are making changes. Rebalancing of portfolio, revision of portfolio happens frequently. But this kind of index funds we classify as passive managed funds. It means once it is invested, carefully it is invested at the beginning, will reap the gain at the end or over the period of time. That is what here it is called, the index funds are passively managed. They carry with them the low expenses ratio, relatively low portfolio turnover ratio, thus have a low risk in the market. Relatively low risk in the market. The next important concept is exchange traded funds. The securities, it is being traded in the market. You can buy the securities and can sell the securities through the stock exchanges. So in the stock exchange, which can facilitate for you about the tradability, marketability and liquidity of the securities being ensured in the exchanges, similar way the funds are being traded in the market. You know that instead of investing into a single securities or a group of securities, it is going to invest into the mutual fund. Across the different securities, the investment is proposed by the asset management companies. So it is similar to the shares, how it is listed in the stock exchange. Similar way, the funds are listed in the stock exchange called exchange traded funds. It means how similarly you can buy the shares, sell the shares in the market. Similar way you can buy the funds and sell the funds in the market. That we call it as the exchange traded funds. It can be traded in the exchange. And you can take, it can be bought and sold in the stock exchanges on real-time basis. How the stock prices are changing every second or every nanosecond, how it is changing. Similar way, the fund performance is also changing. You can able to buy and sell the funds in the market. That is what it is called it as exchange traded funds. It is asset management company may not offer the sale and repurchase of unit. That may happen. And ETF can be traded respective stock exchanges and can benchmark their respective, irrespective of their index, they can benchmark. It means their performance may be outperformed compared to the index, what they have as benchmark index in the market. And exchange traded funds which are available for pre-specified equity indexes and also those mirrored in the price of a gold. It is not only for the stocks, exchange traded funds, it is not like a stock, the funds, even it is investing in the gold, called gold exchange traded funds, which are familiar in the market segment. Irrespective of buying physical gold, investors are interested to buy electronic gold. Instead of making investment, they can able to buy the fund, electronic exchange traded, it means gold exchange traded funds where you can able to invest. Most of the electronic fund, it means traded funds are passively managed. The next one is about the fund of fund scheme. What is fund of fund scheme? The fund of fund scheme, it is investing in other funds. In some mutual fund houses or other mutual fund houses, they are investing. For example, if Reliance has its own fund, Reliance has a fund of fund scheme, for example, they are investing into other schemes run by the Reliance Asset Management Company, like Reliance Diversified Advantage Scheme, Reliance Bank Equity Scheme, Reliance Automobile Sector, Reliance Infrastructure Fund, like the 4 different funds in which the fund of fund scheme is going to invest. We can say it is invested into same mutual fund company, or it is investing in other mutual fund companies. You can take relatively in the market the diversified equities segment where the Reliance is performing well, and similar to this the liquidity funds, the liquid funds where the Life Insurance Corporation Asset Management Company is performing well in the market. Banking financial services sector, which the ICICI Prudential is performing well in the market. So a scheme has started by the asset management company is going to invest across the different schemes run by the different asset management company. We call it as fund of fund scheme. Either it can be invested into the own fund house, or it is invested across the different fund houses. We call it as fund of fund scheme. The second important aspect, the fund of fund scheme would have the mandate to invest the funds focusing on investing into various asset classes or the market or the regions, different region in which they are investing, and provide an opportunity to the investor to create a diversified portfolio of various mutual fund schemes where they are investing. You know that it is investing into different securities. We call it as, instead of investing into single security, is going to invest across the different security. The concept is called it as mutual fund. If different types of mutual funds, the investment is proposed by the asset management company is called fund of funds scheme. So this fund of funds scheme that provides an opportunity to create a diversified portfolio of various mutual fund schemes, whereby one can avail the benefit of diversification by the fund manager and investment style. The pattern is entirely differ in the market. And the fund of funds scheme, which may help for the diversification across the types and investment style, it relieves you from the process of selecting the right mutual fund scheme, reduces the hassles such as the multiplication of transactions, filling of forms, maintaining of multiple account statement, tracking of multiple mutual fund scheme. In spite of that, a single scheme is going to invest into the number of schemes. And those that the concept of exchange traded funds. Exchange traded funds are invested into, it means investment of funds traded in the stock exchanges. It can be in the form of stock, in the form of gold, or in the form of other instruments can be available in the market. Real time it can be traded in the market. And then gold exchange traded fund holds the assets like stocks, commodity, bonds can be traded in the market. It can be on the net asset value over the course of a trading day. And most of the exchange traded funds track on index, such as index funds. We call it as index fund or the bond index. There are certain types of exchange traded funds can be classified as the equity funds. Most of the exchange traded funds in the market, either it can be in the form of equity index or a sectoral index, or in the form of direct equities. It means the investments into direct equities fund, equity funds, fixed income fund, exchange traded fund, and commodity fund like gold exchange traded fund, currency exchange traded funds, real estate exchange traded fund, investing in real assets. So these are the different investments in exchange traded funds. So as together in this particular concept of equity fund, different investments are proposed. Equity investments are subject to market risk. Equity investment is based on the market prices, based on the market movement. Investors are giving priority for equity fund which are actively managed rather than the passive funds.